Today, we're going to talk about Social Security, not headlines, not myths, and not one line advice you hear online, but how Social Security actually works and how the decisions you make can impact your income for the rest of your life. For many people, Social Security becomes one of the single largest sources of retirement income they will ever receive. Yet it's also one of the most misunderstood parts of retirement planning. Most people spend more time researching a car purchase than they do deciding when and how to claim Social Security, even though this decision can affect hundreds of thousands of dollars over a lifetime. One of the most important things to understand right up front is this: Social Security decisions are often permanent. Once you claim, there are very limited windows to change your mind. That means mistakes are hard and sometimes impossible to undo. The problem is that most people don't make these decisions based on strategy. They make them based on fear, hearsay, or convenience. They hear things like, just take it as soon as you can, or it won't be there anyway, or everyone should do the same thing. And while those statements might sound confident, they're rarely accurate. Social Security is not a one size fits all decision. The right claiming strategy depends on several factors: your earnings history, your health, whether you're married or single, how long you expect to work, and how Social Security fits into the rest of your retirement income and tax picture. The goal of today's session is not to tell you what to do. The goal is to help you understand how to think about Social Security so you can make informed decisions with confidence instead of guessing. By the end of this presentation, you should have a much clearer understanding of how benefits are calculated, how claiming ages affect your income, and why timing and coordination matter so much, especially for married couples. This is an educational session. There's no product pitch, no pressure, and no single quote unquote right answer for everyone. Just clarity, education, and better decision making, which is exactly how something this important should be handled. To understand why Social Security deserves so much attention, we need to step back and look at how retirement income has changed over time. Years ago, many retirees relied heavily on pensions. Those pensions provided a predictable monthly income that lasted as long as a retiree lived. Today, pensions are far less common, which means Social Security has quietly become the closest thing many people have to a guaranteed paycheck in retirement. For most retirees, Social Security isn't just extra money, it often becomes a foundation of their income, the baseline that helps cover essential expenses like housing, food, utilities, and healthcare. Everything else in retirement planning tends to build around it. Another reason Social Security is so important is that it is designed to last you for your lifetime. No matter how long you live, the benefit continues. That makes it very different from investment accounts, which can be drawn down or depleted over time if withdrawals are too aggressive or markets perform poorly. Social Security benefits are also adjusted for inflation. Each year, benefits may increase through cost of living adjustments. That inflation protection is extremely valuable, especially in long retirements where purchasing power can erode faster than many people expect. Because Social Security plays such a critical role, the timing of when you claim benefits can have a ripple effect throughout your entire retirement plan. Claiming earlier may provide income sooner, but it also reduces the amount you receive for the rest of your life. Claiming later may require drawing from other assets first, but it can significantly increase guaranteed income later on. This is why Social Security isn't something you want to treat as an afterthought. It influences how much you withdraw from savings, how long your investments need to last, and how flexible your plan can be if unexpected expenses or market volatility arise. When Social Security is claimed thoughtfully, it can create stability and confidence. When it's claimed without understanding the long term consequences, it can limit options and create unnecessary pressure on the rest of your retirement resources. One of the biggest reasons people make poor Social Security decisions is because they're relying on myths instead of facts. These myths get repeated so often that they start to sound like common sense, even when they're not true. The first myth is you should take Social Security as soon as possible. This advice usually comes from fear that Social Security will run out, fear that someone won't live long enough, or fear that the rules will change. While claiming earlier may be appropriate in some situations, it is not automatically the best choice. Claiming early results in a permanent reduction in benefits, and that reduction follows you for the rest of your life. The second myth is Social Security won't be there anyway. Social Security does face long term funding challenges, but that does not mean benefits are disappearing. Historically, when changes have been made, they've affected future retirees more than people who are close to or already in retirement. Planning based on the assumption that Social Security will vanish often leads people to make rushed or suboptimal decisions. The third myth is everyone should do the same thing. This is one of the most dangerous assumptions. Social Security decisions are highly personal. A single person, a married couple, a higher earner, a lower earner, someone is in excellent health, and someone with health concerns all face very different trade offs. What makes this even more complicated is that Social Security interacts with other parts of your financial life: taxes, investments, employment, and spousal benefits. Ignoring those interactions can lead to unintended consequences. The key takeaway here is that advice that sounds simple is usually incomplete. Social Security is a rules based system, and small differences in timing and coordination can produce very different outcomes over a lifetime. The goal of this presentation is to replace these myths with understanding so that instead of guessing or following someone else's path, you can make decisions that are aligned with your own goals and circumstances. Before we talk about when to claim Social Security, it's important to understand how benefits are earned in the first place. Many people assume Social Security works like a personal savings account, that what you get back is directly tied to what you personally paid in. In reality, it works very differently. Social Security is funded through payroll taxes. While you're working, a portion of your income is withheld and sent into the Social Security system. For employees, this is shared between you and your employer. For self employed individuals, you're effectively paying both sides. As you work and earn income, you also earn credits. Most people need 40 credits, which typically equals about 10 years of work, to qualify for retirement benefits. Once you've earned enough credits, you're considered eligible. But eligibility alone does not determine how much you'll receive. The amount of your Social Security benefit is based on your earnings history over your working lifetime, not just your final years before retirement. This is an important distinction, especially for people who had lower earnings years early in their career, took time off from work, or experienced income gaps. Another common misconception is that earning more later in life always increases your benefits. While higher earning can help, they only matter if they replace lower earning years in your record. If you already have 35 high earning years, additional work may have little or no impact on your Social Security benefit. This is particularly relevant for business owners and self employed individuals. How income is reported, especially when it comes to wages versus distributions, can influence Social Security benefits in ways many people don't realize until it's too late. Understanding that Social Security is based on lifetime earnings helps explain why claiming strategies vary so much from person to person. Two people who retire at the same age can receive very different benefits simply because their earning histories are different. Once you understand how benefits are earned, it becomes much easier to understand how they're calculated, which is what we'll look at next. One of the most important rules in Social Security, and one that surprises many people, is the 35-year earning rule. Social Security calculates your retirement benefits using your highest 35 years of earnings, adjusted for inflation. If you worked more than 35 years, only your highest earning years are used. If you work fewer than 35 years, the missing years are filled in with zeros. Those zero income years can have a significant impact. Even a handful of zero or very low earning years can pull down your average and reduce your benefit for the rest of your life. This is especially important for people who took time off to raise children, care for family members, return to school, or step away from work for other reasons. It's also common among business owners who may have had years where income was intentionally kept low for tax reasons. Another key detail is that Social Security indexes your earnings for inflation. This means earlier earnings are adjusted to reflect today's wage levels, helping create a fair comparison across decades. However, indexing doesn't eliminate the impact of low earning or zero earning years. It only adjusts the dollars. This rule helps explain why working longer can sometimes increase your Social Security benefit, but not always. It continuing to work replaces a zero or very low earning year in your 35-year history, your benefit may increase. If it simply replaces a higher earning year, it may not change much at all. Understanding this rule can be empowering. It allows you to look at your earnings record and see where opportunities may exist or where expectations should be adjusted. Many people assume Social Security calculations are mysterious or arbitrary. In reality, they follow a set of rules. Once you understand those rules, you're in a much better position to make informed decisions about your retirement income. Now that we've talked about the 35-year rule, let's look at how Social Security actually turns your earnings history into a monthly benefit. This is where two important terms come into play: AIM and PIA. First is AIM, which stands for Average Indexed Monthly Earnings. Social Security takes your highest 35 years of earnings, adjusts them for inflation, adds them together, and then averages them out into a monthly number. That number is your AIM. Think of AIM as a snapshot of your lifetime earnings, expressed as a monthly average. This number is not your benefit. It's simply the starting point. Next is PIA, or primary insurance amount. Your PIA is the benefit you would receive if you claim Social Security at your full retirement age. This is the key number that everything else builds from. Social Security uses a formula with what are called the bend points to calculate your PIA from your AIM. Without getting too technical, this formula is progressive, meaning lower levels of income are replaced at a higher percentage than higher levels of income. That's why Social Security tends to replace a higher percentage of income for lower earners than for higher earners. Once your PIA is established, it becomes the anchor for all claiming decisions. If you claim early, your benefit is reduced from your PIA. If you claim at full retirement age, you receive 100% of your PIA. If you delay claiming, your benefit increases above your PIA. This is why it's so important to understand that claiming age doesn't change how your benefit is calculated. It changes how that calculation benefits is adjusted. The math has already been done by the time you reach retirement age. Many people focus only on the monthly check they see on a statement without realizing how much strategy is involved behind that number. When you understand AIM and PIA, you begin to see Social Security not as a mystery, but as a system, one that can be planned around thoughtfully. With this foundation in place, we can now talk about one of the most important milestones in Social Security planning: full retirement age. Now that we understand how benefits are calculated, we need to talk about full retirement age, often abbreviated as FRA. This is one of the most important reference points in Social Security planning, yet it's also one of the most misunderstood. Full retirement age is not the age at which you are required to retire. It's not even the age at which most people actually retire. Instead, it's simply the age Social Security uses as a benchmark to determine how your benefits are adjusted. Depending on your year of birth, full retirement age falls somewhere between 66 and 67. For people born earlier, it may be closer to 66. For those born later, it's closer to 67. This is why two people who are only a few years apart in age can have different full retirement ages. Your full retirement age matters because it determines what your primary insurance amount actually pays. If you claim benefits exactly at your full retirement age, you receive 100% of your calculated benefit. No reductions and no increases. Claiming before full retirement age results in a permanent reduction. Claiming after full retirement age results in an increase up until age of 70. So full retirement age becomes the midpoint that all claiming decisions revolve around. Another reason full retirement age is important is that several other Social Security rules change once you reach it. For example, the rules around working while collecting benefits are different before and after full retirement age. Spousal benefits are also affected by when each spouse reaches their full retirement age. Many people assume that reaching full retirement age means they should automatically file for benefits. In reality, it simply gives you options. Some people benefit from claiming right at that point. Others benefit from waiting. The right choice depends on how Social Security fits into the bigger picture of retirement income, taxes, and longevity. Understanding full retirement age gives you a reference point, not a directive. It allows you to evaluate the trade-offs of claiming earlier or later and clarity instead of confusion. With that foundation, we're now ready to look at what happens if you claim benefits before full retirement age, starting at the earliest possible age. Age 62 is the earliest point at which most people can begin claiming Social Security retirement benefits. Because it's the first opportunity to receive income, many people are naturally drawn to it, especially if they're eager to retire or concerned about their health. What's critical to understand is that claiming at 62 comes with a permanent reduction in benefits. This is not a temporary penalty, and it does not go away once you reach full retirement age. The reduction lasts for the rest of your life. For most people, claiming at 62 results in a reduction of roughly 25 to 30% compared to what they would receive at full retirement age. That means smaller monthly checks every month for as long as you live. This decision also affects other benefits. For married couples, claiming earlier can reduce potential survivor benefits for a spouse later on. That's an important consideration that often gets overlooked when people focus only on their own monthly income. Another factor to consider is longevity. Claiming early may provide income sooner, but it shifts more of the long-term risk onto you. If you live a long life, which is increasingly common, smaller benefits can put additional pressure on other retirement assets later on. That said, claiming at 62 is not always a mistake. In some situations, it can make sense, particularly if someone has health concerns, limited savings, or needs income immediately. The key is that the decision should be intentional and informed, not automatic. Too often people claim at 62 simply because it's available without fully understanding the trade-offs. Social Security doesn't penalize you for waiting, but it does permanently reduce your benefit for claiming early. The goal is not to label early claiming as bad, but to understand what you're giving up in exchange for receiving income sooner. Once you understand that trade-off, you can decide whether it aligns with your overall retirement goals. Next, we'll look at what happens when you wait until full retirement age and how that compares to claiming early. Claiming Social Security at full retirement age means you receive 100% of your primary insurance amount, the benefit Social Security calculated based on your earnings history. There are no reductions for claiming early and no increases for delay. For many people, full retirement age feels like the safe choice. It avoids the permanent reduction that comes with early claiming, and it doesn't require waiting until age 70. Because of that, it's one of the most common claiming ages. However, claiming at full retirement age is not automatically the best strategy. It's simply the neutral point in the system. Whether it's the right decision depends on how Social Security fits into the rest of your retirement picture. One advantage of claiming at full retirement age is flexibility. You can collect your full benefit while continuing to work without facing the earnings limits that apply before full retirement age. That makes this option attractive for people who plan to work part-time or consult in retirement. For married couples, claiming a full retirement age may allow one spouse to begin benefits while the other delays, creating a coordinated approach that balances income needs today with higher benefits later. Another factor to consider is cash flow. Claiming a full retirement age provides income at a point when many people are transitioning into retirement, which can reduce the need to draw heavily from savings or investment accounts. At the same time, choosing full retirement age over delaying means giving up future increases. Every year you delay beyond full retirement age increases your benefit up to the age of 70. Whether that trade off is worthwhile depends on health, longevity expectations, and the need for guaranteed income later in life. The most important takeaway is this: full retirement age is not a recommendation, it's a reference point. It gives you a clear baseline so you can compare the costs and benefits of claiming earlier or later. Next, we'll explore what happens if you delay Social Security beyond full retirement age and why doing so can be a powerful strategy for some people. Once you reach full retirement age, Social Security gives you another option: delaying benefits. This option is often overlooked or misunderstood, but for some people, it can be one of the most powerful strategies available. When you delay claiming Social Security beyond full retirement age, your benefit increases by approximately 8% every year. These are called delayed retirement credits. This increase continues until age 70, at which point there is no further advantage to waiting. What's important to understand is that this increase is not a one-time bonus. It permanently raises your monthly benefit for the rest of your life. It also becomes the new base amount for future cost of living adjustments, which means inflation increases apply to a higher starting number. From a planning perspective, delaying Social Security creates the highest guaranteed inflation-adjusted income stream most people will ever have. There is no market risk, no investment volatility, and no concern about running out of money as long as you're alive. Delaying benefits can be especially valuable for people who expect to live longer than average, those who are still working, or those who have sufficient savings to bridge the gap between retirement and age 70. It can also be a critical strategy for married couples, particularly when one spouse earns significantly more than the other. For the higher earning spouse, delaying benefits doesn't just increase their own income, it can also increase survivor benefits for the remaining spouse later on. In many cases, this is less about maximizing income today and more about protecting income decades into the future. Of course, delaying Social Security is not the right choice for everyone. It requires using other income sources in the meantime, and not everyone has the flexibility to do that. Health concerns, immediate income needs, and personal preferences all play a role. The key is understanding the trade-offs. By delaying, you're giving up income today in exchange for higher guaranteed income later. Whether that trade makes sense depends on your overall retirement plan, not just Social Security in isolation. The purpose of this discussion isn't to convince anyone to delay. Is to make sure you understand that waiting is an option and that in the right circumstances, it can significantly strengthen long-term retirement security. Next, we'll shift our focus to married couples and how Social Security benefits work when more than one person is involved. Now, once you're married, Social Security planning becomes significantly more complex and also more powerful. This is because Social Security is not just an individual benefit system. It also includes spousal benefits that are often misunderstood or overlooked entirely. A spousal benefit allows one spouse to receive up to 50% of the other spouse's primary insurance amount, assuming the claiming spouse has reached their own full retirement age. This benefit is based on the higher earning spouse's work record, not the spouse who is receiving the benefit. One important clarification: claiming a spousal benefit does not reduce the other spouse's benefit. This is not a shared or split payment. It's a separate benefit that Social Security allows under the rules. However, timing matters. If a spouse claims spousal benefits before their own full retirement age, the spousal benefit is permanently reduced, just like claiming early on your own benefit. This is why coordination between spouses is so important. Another common misconception is that a spouse can choose between their own benefit and a spousal benefit. In reality, Social Security automatically pays the higher of the two, but the process depends on when each spouse claims and how the benefits interact. For many couples, especially when one spouse earns significantly more than the other, spousal benefits can provide meaningful income that otherwise might be missed. This is particularly relevant when one spouse spends time out of the workforce or earn lower wages for much of their career. Spousal benefits also influence claiming strategies. In some cases, one spouse may choose to claim earlier while the other delays, creating a balance between immediate income and higher future benefits. In other cases, both spouses may delay to maximize long-term security. The key takeaway here is that Social Security decisions should not be made independently when you're married. What one spouse does directly affects the options and outcomes for the other. Without coordination, couples can unintentionally leave money on the table or reduce long-term income, especially when survivor benefits come into play, which we'll discuss next. Understanding spousal benefits allows married couples to think strategically instead of individually, which is exactly how Social Security was designed to work for families. Survivor benefits are one of the most important parts of Social Security, and unfortunately, one of the least understood. Yet for many families, survivor benefits end up being far more important than retirement benefits themselves. Here's the basic rule. When one spouse passes away, the surviving spouse does not continue receiving both Social Security checks. Instead, the surviving spouse keeps the higher of the two benefits. That single rule has major implications. It means that the claiming decision made by the higher earning spouse can directly affect the income of the surviving spouse, potentially for decades. If the higher earning spouse claims early and locks in a reduced benefit, that reduced benefit may become the survivor benefit later on. On the other hand, if the higher earning spouse delays benefits and increases their Social Security check, that higher amount can provide greater long-term protection for the surviving spouse. This is why Social Security planning is not just about maximizing income while both spouses are alive. It's also about protecting the spouse who may live longer, which is very often the case. Survivor benefits can begin as early as age 60 for their surviving spouse or age 50 if their surviving spouse is disabled. However, claiming survivor benefits early can result in a reduced amount, just like claiming retirement benefits early. Another important detail is that survivor benefits and retirement benefits follow different rules. In some situations, a surviving spouse may be able to claim one type of benefit first and switch to another later. These options depend on timing, age, and personal circumstances. What often happens is that couples focus only on maximizing income while they're both alive, without realizing that one of them is likely to live significantly longer than the other. Survivor benefits are designed to provide stability during that later stage of life. This is especially important when we consider that expenses don't always decrease when one spouse passes away. Housing, healthcare, and daily living costs often remain, even though household income may drop. The key takeaway is this. Social Security decisions should be made with both lives in mind, not just the present moment. Survivor benefits are not a side issue. They are a core part of responsible retirement planning. Next, we'll look at what happens if you continue working while collecting Social Security and how those rules change depending on your age. A very common concern people have about Social Security is whether they can continue working while collecting benefits. This is an area where misinformation causes people to make decisions based on fear rather than facts. The first thing to understand is that the rules depend on your age. If you are below full retirement age and you are collecting Social Security, there is an earnings limit. If you earn more than that limit, a portion of the Social Security benefits may be temporarily withheld. What's important to emphasize is the word temporarily. This is not a penalty, and it does not mean the money is lost. When benefits are withheld due to excess earnings, Social Security later recalculates your benefit and gives you credit for those withheld months once you reach full retirement age. In other words, Social Security is not punishing you for working, it's simply adjusting the timing of when benefits are paid. Once you reach full retirement age, the earnings limit goes away entirely. At that point, you can earn as much as you want, continue working full time or part time, and still receive your full Social Security benefit with no reduction. This distinction is critical for people who plan to transition gradually into retirement. Many individuals work part time, consult, or run small businesses well into their 60s and beyond. Understanding how the earnings rules works allows you to plan around them instead of being surprised by them. Another common misunderstanding is a belief that working while claiming permanently reduces your benefit. That is not the case. Any benefits withheld before full retirement age are factored back into your benefit calculation later. The real risk here is not working while collecting Social Security. The real risk is misunderstanding the rules and making a claiming decision based on incorrect assumptions. When these rules are properly understood and coordinated with claiming age, Social Security can remain flexible rather than restrictive. Next, we're going to talk about another area that often catches people off guard: taxes on Social Security benefits. One of the biggest surprises for retirees is learning that Social Security benefits can be taxable. Many people assume that because they paid into the system for decades, the benefits they receive must be tax free. Unfortunately, that's not always the case. Depending on your income, up to 85% of your Social Security benefits may be subject to federal income tax. Notice I said up to 85%. That does not mean you're taxed at an 85% rate. It means that that portion of your benefit may be included in your taxable income. Whether your benefits are taxable depends on something called provisional income. Provisional income is a formula Social Security uses that includes your adjusted gross income, tax-exempt interest, and half of your Social Security benefits. This is where many people run into trouble. Even if your Social Security check itself seems modest, other income sources can push you into a range where taxation kicks in. Common triggers include pension income, required minimum distributions from retirement accounts, part-time work, or large withdrawals from your investment accounts. What makes this particularly frustrating is that the income thresholds used to determine Social Security taxation have not been adjusted for inflation. That means more and more retirees are finding themselves paying taxes on Social Security, even though they didn't expect to. Another important point is that Social Security taxation is not an all or nothing situation. You may have a portion of your benefit taxed while the rest remains tax free. However, once you cross certain income levels, the tax impact can increase quickly. This is why Social Security claiming decisions should never be made in isolation. The timing of when you claim benefits, how you withdraw money from retirement accounts, and how other income sources are coordinated can all influence how much of your Social Security is taxed. The goal here isn't to create fear, it's to create awareness. When taxes are anticipated and planned for, they can often be managed. When they're ignored, they can significantly reduce your net retirement income. In the next slide, we'll take a closer look at what actually triggers Social Security taxation and why thoughtful income planning can make such a big difference. Now that we know Social Security can be taxable, the natural question becomes, what actually triggers those taxes? The answer lies in something called provisional income. This is not a number most people see on their tax return, but it's the number Social Security uses behind the scenes to determine whether and how much of your benefits are taxable. Provisional income is calculated by taking your adjusted gross income, adding any tax-exempt interest, and then adding half of your Social Security benefits. That total is compared to income thresholds set by the IRS. Here's where people get caught off guard. Social Security itself may not push you over the threshold, but other income sources often do. Common examples include pensions, required minimum distributions from retirement accounts, part-time wages, or large withdrawals from IRAs and 401ks. Even income that people think of as tax efficient, such as municipal bond interest, can still count toward provisional income and increase Social Security taxation. This is one of those areas where assumptions can be costly. Another challenge is timing. If multiple income sources hit in the same year, for example, claiming Social Security while starting required distributions or selling an investment, the combined effect can significantly increase how much of your benefit is taxed. What makes this especially frustrating is that the income thresholds used to determine Social Security taxation are relatively low and have not been indexed for inflation. As a result, more retirees find themselves paying taxes on Social Security every year, even if they consider themselves middle income. The good news is that it is often a planning issue, not an inevitability. By coordinating when you claim Social Security, how you draw from retirement accounts, and which income sources you use first, it's sometimes possible to reduce or manage the tax impact. The key takeaway here is that Social Security taxation is not random. It follows a formula. And when you understand that formula, you gain the ability to make smarter decisions instead of being surprised at tax time. Next, we'll step back and look at the most common claiming mistakes people make and how those mistakes can compound over time. At this point, you could probably see that Social Security is not complicated because it's confusing. It's complicated because the decisions are connected. Many of the biggest mistakes people make come from treating Social Security as a standalone decision instead of part of a larger retirement plan. One of the most common mistakes is claiming without a plan. People file for benefits simply because they reach a certain age. A coworker did it, or someone told them they should. There's often no analysis of how long they expect to work, how long they might live, or how Social Security fits into their overall income strategy. Another major mistake is ignoring the impact on the spouse. When couples make decisions independently without coordinating timing, they can unintentionally reduce spousal or survivor benefits later on. This is especially costly when one spouse earns significantly more than the other. Taxes are another area where mistakes add up. Many retirees claim Social Security without considering how it will interact with other income sources. Then, years later, they're surprised to find that a large portion of their benefit is taxable, reducing the net income they actually keep. Some people also assume that once they claim Social Security, there's nothing left to think about. In reality, claiming is just the beginning. How benefits are taxed, how withdrawals are taken from retirement accounts, and whether income is coordinated properly all continue to matter. A related mistake is focusing only on the monthly check instead of looking at lifetime income. A smaller check today may feel safer, but over a long retirement, that decision can significantly reduce total income, especially when inflation and longevity are factored in. What's important to understand is that most of these mistakes are not caused by negligence, they're caused by lack of education. Social Security rules are rarely explained clearly, and people are often left to figure it out on their own. The purpose of education, like what we're doing today, is to replace guesswork with understanding. When you know the rules and how they interact, you can avoid the most common pitfalls and make decisions that support long-term confidence instead of short-term convenience. Next, we'll step back and reframe Social Security as what it really is, a long-term strategy, not just a monthly payment. One of the most important mindset shifts in Social Security planning is realizing that it is not just a monthly check, it's a long-term strategy. Social Security interacts with almost every other part of retirement planning. It affects how much you withdraw from savings, how long your investments need to last, how much flexibility you have during market downturns, and even how much risk you can afford to take. When Social Security is claimed thoughtfully, it can reduce pressure on investment accounts by providing reliable income that lasts as long as you do. That can be especially valuable during periods of market volatility, when drawing too much from investments can permanently damage a retirement plan. Social Security also plays a role in tax planning. The timing of when benefits begin, combined with how other income sources are managed, can influence how much of your income is taxed year after year. Small decisions made early can have lasting effects. For married couples, Social Security becomes a shared strategy rather than an individual one. Coordinating benefits can help balance income needs today with protection for the surviving spouse later on. Another important aspect is longevity. Retirement is lasting longer than many people expect. Social Security provides guaranteed, inflation adjusted income no matter how long you live. Treating it as a strategy rather than a switch allows you to better prepare for a long retirement. When people focus only on the earliest possible check, they often underestimate the value of the guaranteed income later in life. On the other hand, when Social Security is viewed as part of a broader plan, it becomes a tool for stability rather than a source of anxiety. The goal isn't to maximize Social Security in isolation, it's to optimize it within the context of your entire financial picture. That's what transforms Social Security from a confusing government program into a meaningful component of a confident retirement. Next, we'll look at what a proper Social Security review actually includes and what separates planning from guesswork. At this point, the natural question becomes, what does a proper Social Security review actually look like? A real review goes far beyond looking at a single monthly benefit number or picking an age off a chart. It involves understanding how different claiming decisions affect income over your entire lifetime. One key component is claiming age comparisons. This means looking at what happens if you claim early, at full retirement age, or delay benefits, and comparing not just the monthly checks, but the total income received over time. Another important element is lifetime income impact. Two strategies might look similar early on, but produce very different results over 20 or 30 years. A proper review focuses on sustainability and long term confidence, not just short term cash flow. For married couples, a review must include spousal and survivor benefit analysis. This looks at how benefits coordinate while both spouses are alive and how income changes when one spouse passes away. For many couples, this is the most critical part of the analysis. A proper review also considers tax implications. When you claim Social Security affects how other income sources are taxed and how much of your Social Security benefit you actually keep. Ignoring taxes can significantly reduce net retirement income. Another often overlooked factor is timing other income sources. Coordinating Social Security with retirement account withdrawals, pensions, or ongoing work can create more flexibility and reduce unnecessary strain on savings. The goal of a Social Security review is not to find a perfect answer. It's to understand trade-offs. Every strategy involves giving something up in exchange for something else. A good review makes those trade-offs clear. When people go through this process, they often feel a sense of relief, not because the decision became easy, but because it became understood. Clarity replaces uncertainty. With that clarity in place, we can now wrap up with the most important takeaways to keep in mind before making any Social Security decisions. As we begin to wrap things up, it's helpful to step back and focus on a few key takeaways that apply to everyone, regardless of when you plan on claiming Social Security. First, Social Security decisions are often permanent. While there are limited circumstances where changes can be made early on, most claiming decisions lock in benefits for life. That makes it especially important to understand the long term impact before filing. Second, timing matters. Claiming earlier at full retirement age or delaying benefits all come with trade offs. There is no universally right age to claim, only what's right for your situation. Third, coordination matters. Social Security does not exist in isolation. It interacts with taxes, retirement accounts, employment, and family circumstances. For married couples, coordinating benefits can make a significant difference in long term income and survivor protection. Another important takeaway is that focusing only on the monthly check can be misleading. A smaller benefit received for a longer period may feel appealing, but over a long retirement, it can result in lower total income and increased pressure on other assets. Education is what turns Social Security from a source of anxiety into a manageable decision. When you understand how the rules work and how they apply to your situation, you gain the confidence, even if the decision itself still feels significant. It's also important to remember that claiming Social Security is not a test you either pass or fail. It's a planning decision. And like most planning decisions, it benefits from thoughtful review and perspective. Whether you're years away from claiming or close to making the decision, the principles we've discussed today can help you approach Social Security with clarity instead of uncertainty. In our final slide, we'll talk about next steps and how to move forward if you have any questions or want a second opinion. If you're watching this presentation on your own time, that tells me one important thing. You care about making informed decisions. Social Security is not something you need to figure out all at once, and it's not something you should feel rushed into. The goal of this presentation was to give you clarity and context, not to push you in any particular direction. Every situation is different. Your work history, your health, your marital status, your tax picture, and how Social Security fits into the rest of your retirement plan all matter. That's why general advice only goes so far. If you have questions after watching this, or if you'd like a second opinion on your Social Security strategy, the best next step is simply to reach out. You'll see our contact information on the screen. You can email us with your questions, or you can schedule a call at a time that works best for you. There's no pressure, no obligation, just a conversation focused on helping you understand your options. For some people, that conversation confirms they're already on the right path. For others, it highlights opportunities or considerations they hadn't been aware of. Either way, clarity is always better than guessing. Whether you're years away from claiming Social Security or approaching that decision soon, take the time to review your options can make a meaningful difference over the long term. If and when you're ready, we're here as a resource. Thank you for taking the time to watch this presentation, and we look forward to connecting if you'd like help applying what you've learned to your own situation.